Let's start with the markets as we always do on the show. We do see fractional gains across the open just about a half hour before the market officially opens for trade. And joining me now with more to set the scene is Dale Smothers. He's CEO and president of RDS Wealth. Dale, it's good to see you down here on the floor of the NYSE.
Good to be here, Kristen.
Yes.
Yeah, I like the setup.
All right, well, what do you make of how the market's setting up today?
Yeah, I really like where we are in the market as a whole and the economy, really. We've got two very important pieces of information coming with CPI and PPI. But as a whole, I think the market is really set to bid higher. And we still have a price target of 8,000 on the S&P 500. That is our target, and we hold true to that. We think we hit there by the end of the year, but I would not be at all surprised if we see some volatility. I know we've talked a little bit. I think 7,000 may even still be doable by the end of the year. 7,000, then back to 8,000 would not surprise me at all because of this volatility, and it's all about the love-hate relationship with tech and AI.
Okay, very interesting. I do want to drill in on that 8,000 number because I see up there on the big board, Dale, out of the corner of my eye, that the S&P is trading at about 7,788. So 8,000 would just be about a 3% gain. I mean, that does seem reasonable.
Of course.
What's going to take it higher?
Yeah, well, clearly the artificial intelligence bid higher is going to be the reason we take this next leg up, in my opinion. But we've seen a broadening out, Kristen, which is healthy, and why I think that this continued bull market extends into 2027 and into 2028 is simply because of a broadening out in the market, not just tech. What takes us to 8,000 is tech. What could very easily introduce a lot of volatility, again, low 7,000s could very easily be in the next couple months here. Could also be because of tech. The love-hate relationship of tech and AI is exactly what's driving this market, and we see the broader market continuing to fill in when those gaps become a rotation from tech into other sectors. We've just seen that over the last 2 months.
Yeah.
It's exactly why I think this is a healthy market for us to be leaning into right now as investors.
Okay, so tech, all about tech, right?
Sure.
The biggest names out there that drive the major indices like the S&P 500 and the NYSX, that's the Global X NYSE 100 ETF. But Dale, how do you marry that with, of course, what we see playing out in the Middle East, volatile oil prices, and midterm elections?
Yeah, midterm elections historically give a little bit of volatility to the market, plus with Iran and oil, we've got to keep a close eye on that. We believe that that's a transitory supply shock, not necessarily something that's going to be around for a long period of time. But how long is long? Well, if you'd asked me at the beginning of the year, I would have thought it would have been resolved by now. Many people would. There has to be a resolution there, Kristen, for us to become very clear that inflation is not going to be sticky and stay around. If inflation sticks around and the Fed has to deal with inflation, it will put a major speed bump in this 8,000 thesis that we have on the S&P 500. So Fed, inflation, oil, Iran, all of those things play into really where we are in the short term. But again, I think the AI build out is going to lead us for the next couple of years into a continued bull run as long as inflation resides.
One thing I want to ask you about, Dale, is that obviously we see AI and technology driving the gains, right? And you've spoken at length about that. But we had an economist on during the jobs report last week, and he said that, believe it or not, despite all this momentum around AI, productivity is actually down. How do we see that AI actually, on a use case basis, filter through into the economy?
This is the unique thing about artificial intelligence. We have all of these expectations, all of these desires for what it could do, but when data comes out that doesn't support that thesis, we have that immediate volatility creep into the market, a sell-off, a rotation, if you will, from artificial intelligence. I don't think that we've seen productivity creep into the overall market just yet, like it will with artificial intelligence. I do think that artificial intelligence brings more productivity, hopefully not at the cost of too many jobs, but we maybe haven't seen the full effect of what artificial intelligence will do for the overall economy at this point in time just yet, because we're still in the build-out phase. We're still in early innings of the artificial build-out, and that could very easily spill over into the productivity numbers as we go.
Is AI supporting you in your job, Dale, in the way that you research and interact with clients?
Absolutely, especially with the research front, and building plans. So what we do at RDS Wealth is we work with those who are close to retirement, and the goal is for us to limit volatility, and being able to do the research that we do would not be possible without a little bit of additional artificial intelligence help. It has certainly helped us in the last couple of years, and then of course by building out these plans, we can you hate to say it, but you have less people on the team and you can do a lot more with less. This continues to be what we're looking for as we build out new technology in our own firm to assist our clients with their day-to-day investment decisions.
When it comes to your clients, what are you recommending right now in terms of portfolio allocation, big picture?
Yeah, we lean into leadership here. Technology is still going to, again, take this market higher. Because we like less volatility, though, there is a play I'm going to mention here. It's the NJUL. It's an innovator ETF that's basically a packaged put-call spread option. It gives us a little bit of upside potential, as much as 20% upside potential on the Qs, and it protects the first 15% of downside movement. We love that type of play for the technology bid higher, but with a little bit of security and safety against downward pressure or volatility over the next 12 months. We like that play in this particular market. If you're looking for volatility suppression or a little bit of insulation from volatility, these option strategy around big names, big indexes make a lot of sense for us.
It sounds like for you, even though it's long-term planning, it still is a headline-driven market that requires active management, no?
100%, and every dollar needs a job inside of a retiree's portfolio. You may have some of that money that's out there hunting for the next big thing. Again, we're leaning into leadership there, looking at names that one in particular up for the earnings call today, CoreWeave. We like those names. The small cap names, we lean a little bit into those, but we like the long-term leadership for our money that's out there hunting, Kristen. The money that we need for income in the next 6 months, it does not belong in the tech sector. Again, staying very dividend focused for those pieces of money make a lot of sense.
Dale Smothers, great to have you down here on the floor of the New York Stock Exchange.
Good to see you, Kristen.
All right, breaking it down for us, Dale is the CEO and president of RDS Wealth.